Good morning. It is March 20th, 2020, and I'm going to do a little review of the several webinars that we've had this week, special webinars for members of Margin of Safety Investing and Seeking Alpha, my service there, and fundamentaltrends.com, my independent service, where we are getting really close to doing some neat things with option trading, swing trading. I'm going to cover a trade today at the end that I think a lot of you can use, and a concept that I think a lot of you can use. And I will give a lot of examples in an article that I write, by tomorrow after the market closes, so that you can all maybe put in some trades on Monday. I know a lot of folks are going to get some puts put to them after the close today. So once you have a grasp on what your portfolio looks like on Monday, I think I have an idea for you, because I know that several positions will be underwater. In general, though, we've been heavy in cash because back at the end of January, some guy, the only one that I could find on all of Twitter with the phrase most important story in the world, was this. On January 23rd, I said, coronavirus is actually the most important story in the world. If you care about the fate of humanity, that is. So I posted this on January 23rd, and I presume the President of the United States has much better information than me and probably knew about this a month to 2 months sooner than I did, because the cases of coronavirus started hitting the Chinese news in early December. Then the Chinese, of course, put the doctors on lockdown who were talking about coronavirus because, oh my gosh, Communist Party wouldn't like anything negative about China to be out there. So I have some definite opinions about the way this is all played out. And I got yelled at for it by one subscriber because he claimed that this was all political rants driven by MSNBC. And it's not. I am not exactly a Republican or a Democrat. So I just would like to disclaim a few things here for folks who think that I'm being pretty partisan or ideological. I'm not really. In fact, people were curious about me, and I've told them where I stand, and they don't always believe it. Well, over on my Facebook page, just for funsies, I did this little quiz, and you've heard me say in the past, if you've been with me a year or two, that I'm a Demopublitarian. The hell is that? Well, I'm liberal, right? Not super liberal, not Bernie Sanders liberal, probably Elizabeth Warren liberal. And I lean libertarian. Why? Why do I lean libertarian? Because I believe that freedom is at the crux of having a happy life. I believe that freedom is the one thing that we should cherish above all other things. And when I see government controls, I get a little scared. Not a lot scared, but a little scared. And I wonder how many people really think about the possibility of losing their freedom. I know that it crossed some people's mind on 9/11. And now that there's going to be a nationwide lockdown, probably state by state, because I don't think Trump will order it. But maybe he will. I hope he does. I think there should be a same sort of thing that happened in California the last couple of days should go nationwide. We should all be told to stay home for a month, except for essential going out, work, where we have to work, picking up groceries, things like that. Spend a month playing board games, video games, whatever it is you like. Catching up on 6 seasons of Vikings, something along those lines. That's what I'm doing. In any case, I'm a Demopublitarian. And when I click this, kind of see how I compare, right? Milton Friedman is the guy that came up with the helicopter money idea. You've heard me talk about helicopter money quite a few times, haven't you? So I'm right in here, kind of between horn dog Bill Clinton and Milton Friedman. I don't know. I don't know what that even means, right? As libertarian as George W. Bush, not as much as Ronald Reagan, certainly not conservative. Why? Because I really could give a crap about what you do with your life. If you like doing something, do it. I don't care. I don't need to tell you how to live your life, especially socially. You know, economically, I'm closer to the center line, right, than I am down here, which is where, you know, Bernie Sanders is. I wish Bernie was on here, because Bernie would be over here. In any case, just so I throw that out there, I'm not a terribly ideological guy, because a liberal libertarian, not exactly a Democrat Party, right, because I lean libertarian, and not exactly the Republican Party, because I'm not conservative. I think progress is made by being progressive. In any case, little war going on my Facebook page, because I had promised not to rant about President Trump or anything political back on my birthday, and yesterday I cracked. In any case, I've been talking about how the coronavirus crash will get worse, going way back to February, the end of February. February 27th, I gave the webinar where I told people to make sure they raise cash on that Friday. And on that Monday was the first giant down day. Following Monday, first giant down day. And I had hoped, because I had started getting you ready to start buying here earlier this week, I had hoped that we would have gotten a capitulation on Thursday and Friday today. That has not happened. Yesterday was just a shade up, choppy, but a shade up. And today looks like it should be similar, maybe a shade up, shade down. Because I believe there is false hope about the stimulus and bailout that is coming. The Republicans are talking about $1 trillion, give or take, maybe 1.2 trillion, 1.3 trillion, and they're acting like that's a lot of money. Well, let me remind you that the U.S. economy is around $20 trillion. I'd have to look at the exact number, but that's about right. So $1 trillion should help us, right? I don't think so. I think this downturn is about to get a lot more down. Why? Because a lot of people are going to be out of work. And I'm hearing reports from CEOs and even small business owners I know around town, because I keep calling them. I've called like 25 people that I know. Hey, what are you guys going to do? And they're all saying, well, we're waiting on the government, but I'd sure like to just lay everybody off. I've told you what I think about Ford last night and GM. I think the car companies, which are one of the major employers in the economy, when you take a look at the car makers, then everybody who caters to the car makers. If I'm the CEO of Ford, right? If I'm Ford Jr., whichever one he is, and Henry Clay, whoever he is, Ford Jr. running CEO of Ford, I'm closing permanently probably a third of my internal combustion engine plants, because they're idled right now anyway. Just going to close them. Screw it. Never reopen them. Laying all those people off permanently. Cutting a new deal with the UAW and saying, look, it's going to take us a little time here, but we have it. We have this window anyway. Let's figure out a way to move towards electric vehicles much faster. Right? We have probably a 2-month shutdown anyway. So let's figure this out. That's the phone calls I'd be making if I'm the CEO of Ford. Right? Just the other day, he talked about it's getting really impossible and it doesn't make sense to straddle the old and the new. I know that they're forward looking at Ford. I've seen their fourth industrial revolution technology, their machine learning, their robots. right? One of our videos has the robots right on the cover. So if you take a look at the YouTube page, you see probably 6 or 7 webinars ago, 8 webinars ago, the robots on the front picture. Those are from Ford. Ford built those. They look like the clones from Star Wars. My big concern here is that this $1 trillion bailout is going to fall way short of what the economy really needs. I believe that the economy is going to slow down a lot. I believe that the entire year is going to be negative growth. And I believe that you're going to have a shock to the system so strong in the next month or two that without a major coordinated response from government that helps people pay their bills for a couple of months, that makes sure there's a job waiting for them in a couple of months, this is not going to rebound in a V shape. I think that there are many, many companies in several distressed industries that are going to be L-shaped recoveries, meaning it takes a very, very long time for them to recover, over a year. And I think for the rest of the economy, you're looking at a U-shape where maybe they start coming back by the end of the year. Depends on their cyclicality. Depends on the type of business they're in. What that means is that corporate profits are going to be non-existent this year. What has been the thing that kept the government, the companies healthy? Where has the marginal buying been in the stock market? It's been the buybacks. The buybacks, my friends, are gone. Just not there. Couple left in the technology sector, but you're going to see buyback program after buyback program after buyback program canceled. I said last night or 2 nights ago, I forget which night it was, put your finger in a splint. Stop trying to click and buy something because you think it's almost over. We don't know either way. But the odds of this getting worse again next week, after 2 days where there was no capitulation, could be really bad. Remember, I told you to watch unemployment. That could get really bad really fast. So don't get an itchy trigger finger on wanting to buy stuff. I had some guy, millennial, who I've been irritated with the last couple of days, telling me that, essentially it's like shooting fish in a barrel. You can crush it by buying stocks now. If you remember, I wrote an article, and I'll find it, that I said probably 2.5 years ago, the millennials haven't had their comeuppance yet. They haven't gotten waxed by the market. The waxing is here. So all these folks who think they're going to outsmart the market, when they have no idea of the underlying market structure, when they don't understand that the only real bidder for stocks the last 3 years have been the corporations themselves. And now that that's gone, what's going to happen? You see that the bailout package, even though it's inadequate, what's going to be attached to it, and even President Trump agreed to it, is that it's not going to be used for executive compensation or stock buybacks. They're hoping they can at least stabilize the economy. The Fed's pumping money in, and hopefully that stabilizes the market. Hope is a really bad investment strategy. So if you take a look at what's going on, again, we got this little mini support rally, rebound rally, and it's really minuscule. It's kind of junky for the amount that it's gone up. But you start getting reports in from Morgan Stanley, who, I make a joke about them not having real big balls, seeing as I was a baseball player. But they want to say this is global growth, 0.9% of 2020. That's actually, I take that back. That's kind of a ballsy call for global growth to almost be flat this year. And that probably includes China line because, there's no way they're really growing right now. So Goldman cuts GDP estimate for China, sees a 9% contraction. So Goldman Sachs is being pretty aggressive. I know somebody thought it was funny that I called them Goldman Sucks recently, but they are actually kind of on the ball here. I agree with this. I believe that China's in a recession right now, and I believe that the United States is in a recession right now, not nearly this severe, but we could get there quickly. The Federal Reserve is suddenly bailing out municipalities on their bonds. Think about that. It means that cities and states are going bankrupt already. Goldman Sachs predicts the U.S. GDP to shrink 5% in the second quarter. I think that's probably not aggressive enough. I think the economy shrinks closer to 10% in the second quarter. But yet the government hasn't updated yet. Okay, so you get the blue chip economic indicators here. The Fed still is, still up here. GDP is about to fall off a cliff. A cliff. It's going to be the biggest drop in GDP, the fastest that we've ever seen. Great Depression level stuff. The difference is that this is a shock that nobody really saw coming. I saw a volatility event coming early in the year. Thought it would have something to do with oil, something. I thought there was a volatility event coming. The oil one came. This, right? I mean, I recognized it early, but this is unprecedented. Nobody could see this coming. Although, like I said, going back, if I knew it was starting to come at the end of January, how come the president didn't? This is a website, PwC. Take a look at this. GDP for the year, they're projecting at 1.8%. I think we're going to be at 0 or slightly negative for the year. But then I think 2021 will be much higher than 2.1% because there will be a substantial rebound. So if you take these two numbers together, I bet I'm probably about the same. But this indicates more smoothness. I don't think that's what it is. I think you see the plunge, and then we whittle it back, and then sometime next year we see a really good surge for a couple of quarters. We had originally talked about buying these 5 ETFs just to get back in the market. And I want to clarify how I'm going to get back in the stock market. I'm going to pretty much stick to these 5 ETFs. Why? Because it's easy. It's easy to chart, it's easy to follow, and it's diversified, and you don't introduce company risk. And right now, introducing company risk, individual company risk, is tough because we haven't read all the data from all the companies with all the updated stuff that's going to be coming out. It is very hard to buy individual stocks right now unless you really know a company inside and out, because a lot of information has just changed. So I urge you, stick with the ETFs to get fully invested when the time comes to get fully invested. And then as you do your research, and I do the research, with you, we find companies to invest in. We'll just peel a little bit out of our ETF positions. Easy enough. So if we're at 50% in QQQ, but there's a QQQ stock that we want to own more of, say Google, then if we want to add 3% of our, make 3% of our portfolio Google, take 3% out of our QQQ position, and buy Google. Makes sense, easy enough. I think that's the way to do it. It simplifies the process, less mechanical motion, less chance for a mistake. Just like when I learned how to bowl, just like when I learned how to hit a baseball. Better mechanics, simpler mechanics, allow for a greater margin of safety, less room for error. So I did lower our buy prices, which I'm not going to show on the screen, but take a look at the latest article, really just the update here. I'm actually going to update this whole article, but I didn't have time to do it yet. So I have new buy prices that are basically set to the low end of our range that we originally started talking about quite a while ago. So we have our charts here. This is a public article, so I don't mind showing this. This line is still in play. The S&P 500 going under 200 is still in play. You know, we're up here right now. And we're actually still above that. So we should be very, very, very careful. There's not going to be extra money out there to buy stocks for a while. So the strategy that I want to give you is to sell long-term call options. People have asked me, well, when this crash is over with, should we buy leaps? My answer is no. Why? Buying leaps involves a lot of time value. You're paying for a lot of time value. It's more economical to buy shorter term calls when you try to call turning points using technical analysis, quantitative data, you know, our money flows that in every other webinar I've thrown out there. I'm not going to really go through it again today. I'll show one chart in a minute though. And just roll your calls over and over and over again. It's cheaper to do that than it is to buy a leap. Right now, though, we have a large position in GDX, Gold Miners ETF. What you might want to consider doing is selling a long-term leap. I, this morning, have been selling the $30 leap on GDX. Why? Well, because I have GDX is my biggest position right now. It's over 10% of my portfolios. It's actually creeped up into the teens, which is a little bit more than it should be. And I want to pull some money out. So my average cost is about $20 a share because I got it at about 23 and change. Running out of tea here, getting scratchy. Been taking my temperature though. I'm good. So if you sell this $30 leap, then you could do 29, 28, 31, 32, depending on what you want to do. Collect the premium. It's a pretty big premium. And it still allows this leap to go up 50%, give or take, or your position to go up 50% by January. How many of you would like to make 10% today and still have 50% upside, give or take? 45% upside, right? You can engineer something like that in here. You want a little bit more premium with a little less upside? Here, sell this one. You want, you know, a little bit more upside, not as much premium? Go ahead and sell this one. Make sure you take a look at the prices of the options in real time. Make sure that you set your price a little higher than what the last order was. And then if you have to whittle it down a nickel at a time every few minutes, go ahead and whittle it down a nickel at a time until you get the right price, until it executes. Now, also, if you want to be more assertive, you can also sell the puts. I don't think we're going to see GDX go much under 17 or 18 again. In fact, I think it's likely to continue rising. So if you want, sell leaps close to at the money, 21, 20, 19, 18, for January, right? The put leaps. I don't know if that's what they're called, but the long-term puts. Sell the long-term puts and sell the long-term leaps and collect all this premium. You collect $4, $5, $6 a share on a $20, $21 ETF right now. 30%. I mean, you can put 20, 30, 40% in your pocket depending on how you structure this. So here you go. In any case, in my ETF portfolios, I really only own gold and solar. You can do a similar thing with the solar. My pricing isn't quite right. I don't think solar goes down too much under 20. And I don't think it rallies over 30 this year. So that's kind of your range. If you want to sell like $30 leaps on TAN and sell $20 puts on TAN, I think that's a pretty good strategy too. As a way to get your cash involved, it's a way to take some profits on a ETF position. Just got to decide what you think the upside is. I think gold this year has the biggest upside because ultimately, even if they only do $1 trillion now, there's another $1 trillion or $2 trillion coming. The bailouts and the stimulus are going to have to be $3 to $4 trillion. There's just no way around it. Now, I know there's all kinds of guys out there thumping their chest about talking about there shouldn't be bailouts. Yes and no. Certain industries have to be kept in business. Car industry, aerospace industry, airline industry. However, I will tell you this. There is, and we've talked about this before, there is all sorts of private equity money out there. And this comes into why I'm not buying Boeing or Delta yet. I love those companies long term. But they've got a major, major financial crisis going on right now. It would not be surprising to me, and I think it would be the right thing to do, for Congress to go really light on those bailouts. Bail out the people, right? Help people keep their homes and feed their family. That's the most important thing. Help small businesses stay in place. They don't have the resources that Boeing and Delta and all the airlines have, right? The private equity industry can come into the airlines, cruise lines, hotels, and say, hey, we'd like to take a 20, 30, 40% stake, maybe even a 51% or 60% stake in Marriott, in Delta, in Boeing, in whoever, pick an airline, right? Why does the public need to bail out those companies? Take care of the people, right? Create some sort of a bridge, but ultimately, those companies should not be giving money for the future. Should all be money just to take care of the employees. The private equity come in and cut a deal. And that's going to result in a lot of dilution. And shareholders will feel more pain. But honestly, and I've charted this out this week already, the stock market's just at fair value. The stock market's not even undervalued yet with this correction. Why? Because we were so historically overvalued to begin with because of the tax cut sugar high and all the buybacks from corporate executives who were skimming from shareholders. If shareholders want this to not happen again, start standing up to executives that are stealing your money. Because half of the S&P 500 CEOs are doing it. In any case, I don't think the stimulus is going to be enough if they have it at $1.2, $1.3 trillion. I think that's probably less than half of what we need. And there are things that we could do through a 12-week family leave provision, that just let people collect an unemployment check and raise the unemployment amount. We have the mechanical vehicles in place through the unemployment system because an employer doesn't have to fire you outright. They can put you on layoff. I know people don't remember that, but layoff. Hey, I'm going to lay you off for 6 or 8 or 12 weeks, and then you're going to come back. Right? Have everybody go through the unemployment system. It's easy. It's in place. It's online. It's over the phone. And just have the federal government tell all the states, hey, we're going to do federal preemption here. There's no requirements on people to get this. If they ask, you have them check a box. I lost my job. I'm less employed than normal, or I just want to take a 12-week family leave. If they ask you what to do, tell them, hey, you know, the 12-week family leave is the most liberal thing. Just ask for it. If you've earned any money in the past year, we should be giving everybody an unemployment check, a layoff check. We've spent $20 trillion or more to support the banking and financial industries, which in turn have supported a lot of other things over the last decade, since 2008. We can spend a few trillion to make sure people don't lose their jobs. Some of them are going to lose their jobs anyway. The world's changing. Coronavirus is just going to change the world fast. So I'm going to get Ted on here in a second if I see him. And Ted and I talked this morning. I gave him a call at 7:30 this morning. And hey, Ted, I'm going to unmute you. And I'm even going to make you a co-host. So one of the things we talked about was how fast the world's changing. We've already covered in other webinars and other articles. The world is going to this 5G, IoT, edge computing, artificial intelligence, fourth industrial revolution, machine learning, biotech driven, which is going to save us now, world. And blockchain's in there somewhere, and alternative energy, and battery storage, and all that stuff is coming. Well, it's going to come faster now. Coronavirus has changed the world. Which is why I talked about the internet changing the world, and 9/11 changing the world, and the financial crisis changing the world. Coronavirus is having as big an impact as any of those things, I think. Because all these companies that are working from home now are going to realize, hey, what do we need all that office space for? And all those people will work from home 30, 40, 50, 60, 70, 80% of the time, depending on the company now. It's an awful lot of gasoline that doesn't get used, and we got a gasoline glut, an oil glut. Oil ain't coming back. Get up to $40 a barrel sometime this year. Maybe it goes up to 60, 70, 80 if there's a war in the Middle East. But one of the things that I think we should wrap our minds around, this is good for industry, so certain industrial stocks are going to be worthwhile. Energy is going to be cheap pretty much forever. Think about that. Energy's always been expensive. People still don't quite grasp that it's going to be cheap. Energy is going to be cheap forever. So the electrification of the economy is coming even faster. There's going to be more working from home. Restaurants are going to be more takeout, more delivery. Seating space is going to change, right? Tables won't be right up on top of each other. Take a look at what's happened in Hong Kong since SARS. We laugh about the Chinese walking around with the face masks. That's from SARS, right? That's what they did. So social distancing, unfortunately, is probably permanent. People covering their coughs and sneezes, which we always used to do. It's probably coming back in the style. Unfortunately, the curve on infections in this country is high because we have morons who went and hung out at the beach and said things like, if I get it, I get it. And then reporters said, well, Don't you have anybody older in your life that that you see? And then they start going, oh yeah, right. There's some interviews down at the Florida beaches. To all you millennials who aren't listening, so those of you who are listening, you need to yell at a millennial because they need it from time to time. Their self-validation thing, has required us to be really easy on them, and they're about to get another life kick in the ass. And this is going to be a real one. Because all these people in the FIRE movement, the whole retire early thing, yeah. SP 500 might not make any money this decade. We invest in better indexes than that, though. So, you have some millennial who wants to go out and party and mingle it up, slap them across the back of the head like that dude on NCIS. All right. So, Ted, can you hear me? Uh-oh. Can anybody hear Ted?
Let's see here. I can hear you.
I don't see him talking. No. All right. So Ted might not be available. In any case, Ted is going to, he's got a lot of family. You are talking. We cannot hear you. Let me see if there's a button I need to press. Playback. Try that. You heard Ted? All right. So, Ted, I'm not hearing you, but go ahead and talk to the folks.
Okay. Well, I think as you and I
know what you're looking to do.
Earlier today, we talked about the need for raising cash, capital preservation, and as a dividend investor, my focus is on dividend safety, and we're in a whole new ballgame with that. So I think it's urgent to focus on the companies with the strongest balance sheets and the commitment to maintaining and growing the dividend long term. And I've been moving more in that direction probably for the last 3 years or more, because I've been scared since 2015. 2015 is when I began to sense that we're getting pretty far out on the limb. So I have not gone to, during all that time, the cash went up and down in the portfolio, but every opportunity I would move toward people or companies with stronger Standard & Poor's credit ratings and those companies that have been raising dividends 25 years or more. So that's where I am, and raising cash at every opportunity and focusing on safety. And the crazy thing is you get this seesaw market during a bear market with strong rallies and huge spike down.
All right. Okay. So, Ted, I'm going to cut you off there. And if you need to say anything else, why don't you chat over to me, because I can't hear you.
Okay.
But, I think he told you about some ideas he's going to have with covering his quarterly letter and his portfolio review. And I know we talked about dividend stocks. We talked about how the world is changing faster. So when he gets that article out, I encourage you to take a look at it. I want to show you one chart before we go. I showed it last night. It is that Ma and Pa, the general public, has been nibbling in the stocks. See this area right here on the relative strength index? You still have big sellers. You got the general public buying it. What we really wanted to see is for this to just get crushed. And on the weekly chart, we really wanted to see it just keep on going. And what we're going to get at the end of this week isn't what I really had hoped for. I really wanted to see this chart, the monthly chart, get hammered even more. But what happened here on the daily in the last couple of days, I'm not feeling like there's capitulation. It doesn't look like it, right? Bounce back up here. don't like that. It needed to stay oversold. It looks to me like the stock market's going lower. Looks to me like the S&P 500 at least gets down to that 220, 225 range again. But I think that the chart that I showed you earlier, this is still in play. I'm not so sure the worst is behind us. The layoffs are going to be massive. Stimulus isn't going to be enough. And people are going to lose hope, right? False hope rallies are tough. So I'm going to be done here. Ted, do you have anything else you need to finish up with?
No, I'll give the subscribers a preview of the quarterly update. I'll do that before the end of the month.
Yeah. All right. So somebody asked me, do I recommend selling individual stocks? Take a look at your positions and how much you're underwater and how much risk you think that is left. And you're going to have to make a decision if you want to try to sell something and buy it back lower, which isn't always a bad idea. Or do you just want to sell a covered call all the way to January? So like if you own Nutrien from $45 a share and it's at 30 right now, 28, whatever it is, can you write a call to January and get a couple bucks back? Because I really don't want to sell Nutrien at 28.30. It's way below its bottom fishing price. Should never be this low. The thing is, Nutrien, you can't really get much premium. So that's one that you probably just sit on and wait. Then you take a look at some other stocks like Enphase. Enphase is going to get put to me today at, I think, $42.50, and it's down around $28.30. So what I might do, right? So Enphase, and I got like $4 for the call, for the put. I'm gonna get Enphase at $42.50 minus, I think, $4.50 in premium. So $38 is my net cost. It's 28 bucks right now. Can I sell a $40 call or a $50 call and get a few bucks? Right? Something like that. Some of these growth stocks, you might sell long-term calls if you're happy to be in the stock, for longer than a year. Trading this is incredibly difficult, especially when you have a position. One thing about the quadruple witching today, and I know people have asked about that, is a lot of positions are going to get cleaned up by the market makers. That generally lends support to the market on days like this. And I think that by next week, maybe by Monday afternoon, right? Because if there's a stimulus package over the weekend, the initial move will be up, I think. And then people will realize it's not big enough, or maybe the pros already do. I think most of the pros already know that you're just looking for an opportunity to sell in strength. Because this is worrying a lot of people like me. For sure, we should get down to this level into the low 200s, 210, 220, 230 on the S&P. When it goes through there, that's another big hunk down. This range right here is where the bottom is, somewhere. I don't know if it's closer to here or closer to here. We just don't know yet. But I think the response from government's going to not be as robust as it should be, although people won't realize that right away because people just don't understand these numbers on the size of the economy and what it's going to take to get people through, right? It's just because the economy has $20 trillion of GDP, start adding up the numbers, right? Here, very simple. Let's take a look at, let's suppose we get 10% unemployment. I believe that'd be about 16 million people unemployed. And I think that might be light. Times $370 a week. Right? That's $6 billion a week. Just in those benefits, on top of what's already out there for 7 or 8 billion. And what if it ends up being 20% unemployment? So we have 40 million people that need help, and we give them 600 a week, which is probably what we should do, right? Numbers get big quick. So when you take a look at the size of this bailout and the fact that it's probably going to last 8 to 12 weeks, you know, and you got to pay for health insurance out of this, it get expensive fast. So we'll see. All right, I'm going to end this. Just let you know that I think wait and see is a better approach than guessing if this is a bottom. Go watch the President Trump press conference. It's on right now. And keep an eye on your inboxes and on the websites this weekend. I've got like 5 different things started that I'd like to finish. Take care.